Howdy, my fellow Americans. Welcome back to Managerial Finance, where I, El Rushbo, Dr. E, the stout defender of free enterprise and constitutional republicanism, a constitutional republic. I'm here to instruct you on finance, managerial finance. Chapter 4, which is about valuing assets, valuing stocks and bonds, valuation. Homework number 1. Question number 1. What is the general formula used to value a company or a stock? When we see a stock price go across the screen, what does that stock price represent, and how do we derive that value? That stock price represents the price that someone is willing to pay for one share of stock in a company, one share of ownership. How much ownership does that person get? Well, it depends on how many shares the company has outstanding. If the company has one share outstanding, then the owner of that one share owns 100% of the company. If the company has 5 shares outstanding, that owner of one share owns 20% of the company, and so forth and so on. How do you put a value on a stock or on a company? What is a company worth? And we're going to study this for the rest of the semester, not just in Chapter 4, but also in Chapter 8. And we're going to take 2 different approaches. One approach is in Chapter 4, another approach is in Chapter 8. So what is the general formula that we're going to use in Chapter 4? And the answer is the forecast value or price that you think is a fair price for a stock or for a company is equal to the forecast fundamental times the forecast multiple. Okay, so we're going to have to define fundamentals and multiples. And before we do that, let me just say this. Forecast, what does it mean? It means to make an educated guess, to project into the future. And there is uncertainty. You do the best you can. You gather as much information as you can, knowing that what you are doing is an exercise that involves uncertainty. Okay? So you're forecasting these things, which means that your price or value that you come up with is a forecast. It is uncertain. Be mindful of that. Okay, what is a company fundamental? List 3 examples, and where do you find them? So, a company fundamental is accounting items like sales, EBIT, net income, book value. And they're found on the financial statements. Income statement, balance sheet. You know that book value is a synonym for owner's equity. What are the components of a valuation multiple? So we have the fundamental, and now we're going to look at multiple. All right. To come up with a multiple, you put the market price for the company or for the stock, the market price, what someone is willing to pay, in the numerator, and you put the company fundamental, one of these items, in the denominator. So you're creating a ratio, the ratio of price that people are paying to the fundamental. The value of the company or the stock is a function of the fundamental. That is what they are buying. When you buy a company, you're buying sales, EBIT, net income, book value. That's what you're buying. How much should you pay for what you are buying? That is the multiple. Okay? What do companies need in order to grow? And the answer is capital. Capital. Where is the easiest place for companies to get capital? Okay, and the answer is retained earnings. Hopefully a company will generate a profit and will generate positive cash flow that is available to be reinvested in the company to help the company grow. If a company has net income of $150,000 and they pay dividends of $50,000, what is the retention rate? Okay, you got to know the formula. So the question is, how much of the profit that the company generates are they going to keep and use to grow the company? The formula for the retention rate is net income minus dividends divided by net income, or it is EPS minus DPS divided by EPS. Same thing. Net income minus dividends divided by net income, or EPS minus DPS divided by earnings per share. So in this case, we have net income and total dividends. 150,000 minus 50,000 is 100,000 divided by 150,000. The company is retaining 66.7%, 2/3. If they're retaining 2/3, then their payout ratio is 33.3%. 1 minus the retention rate is the payout rate. Okay? If a company has earnings per share of $1.50 and dividends per share of 50 cents, what is its retention rate? Earnings per share minus dividends per share divided by earnings per share, same thing. Same answer. Okay. If a company has net income of $150,000 and earnings per share of $1.50, how many shares does the company have outstanding? And the formula is the total fundamental divided by the fundamental per share equals the number of shares. Here we go. The number of shares, total fundamental, divided by the fundamental per share, 150,000 net income, divided by $1.50 earnings per share, equals 100,000 shares outstanding. Okay, so we set the stage. This is the first homework, and I presented to you some of the fundamental information that you need to go to take it to the next level, which will be the rest of the chapter. So let's take a break, and we'll come back for homework number 2. Peace out. Shalom.